break-even point. Calculation of break-even point. You may ask, what is break-even point before we talk about its computation. When we talk about break-even point, we're talking about the number of units of a product that a company must sell in order to cover all its production costs. At break-even cost, or at break-even level quantity, sales have been made in such a way that there is no loss. The company has covered all its costs. We say it is break-even sales quantity. It can also be expressed in dollars, that's in value. In that case, it represents the amount the company must sell in order to break even, so that all the costs will be covered. There will be no profit, there will be no loss. We call that level break-even point. Now, what is the formula we use in computing break-even point? For break-even point in units, we use total fixed costs divided by contribution per unit of the product. So, let's take an example here. If the total fixed cost for a company is 240,000 and the contribution per unit is 15 naira per unit, then the break-even points in units will now be equal to 240,000 divided by 15. Now, and that will give us 16,000 units. This means that if the company must cover all its costs, it must sell minimum of 16,000 units. Otherwise, it will not be able to cover its costs. So, we call that break-even point in units. Yes, at break-even point level, profit will be zero, and all the costs are covered. We can also express a break-even point in value, and in that case, you can just multiply the units by the break-even point in units by the sales price per unit, or you can also divide the fixed cost by contribution sales margin. You will also arrive at the same figure. Remember to like our videos. This is Tigozi Accounting Academy. Bye for now. In our next lecture, we're going to look at the margin of safety, which is another concept in break-even analysis.